How much will property prices fall during the coronavirus recession? There's no doubt that turnover is dropping and properties in some areas are falling in value, but will they drop 10%, 20%, 30% like some people are suggesting? Which headline do you even start to believe? Well, let's not worry too much about the headlines, because today I'm going to have a chat with Stuart Wemyss, founder and director of Pro Solutions Private Clients, and we're going to give you evidence-based facts that are going to give you a better understanding of what could happen. And as I often find when I chat with Stuart, he's going to challenge some of the myths and the misconceptions. Again, not based on what we'd like to happen, but on facts and figures, so you'll have a better understanding of what's going to happen to unemployment, how that will relate to property prices, and probably not the way you think. We're going to talk about what happened to property values during the last recession and the weak link between unemployment and price growth. We're also going to talk a bit about what you can do to weather the storm from a finance perspective, and we'll give you some direction and clarity to work through the maze that we're walking through together. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
Property values are going to fall 10%. No, they're not. They're going to drop 20%, 30%. Which of these headlines are you going to believe? We all know that forecasts are pretty inaccurate, especially when they're about the future. And we also know that at times of uncertainty, like we're currently experiencing, we look for some more certainties. We look for more forecasts. And as property investors, we want to know what's going to happen with property prices, how far they're going to fall. Will there be a right time to enter the property market? Should I hold on before I buy? So despite my initial disclaimer about the value forecasts, that's exactly what I want to do today when I chat with Stuart Wemyss, the founder and director of Pro Solution Private Clients, who's had over 20 years financial services experience. Now, if you don't know Stuart, he's a chartered accountant, holds many postgraduate qualifications, and regularly writes for the Australian newspaper. He's authored a number of books, including his new book, Rules of the Lending Game. Welcome, Stuart.
Hey, Michael. Great to be with you again.
Now, Stuart, I love reading your blogs and I regularly listen to your podcast. And recently you debunked some myths about the relationship between unemployment and property growth. The forecasters who suggest property values are going to plummet moving forward now, they generally cite things like higher unemployment, which we are going to have, lower economic activity, which is going to happen, lower consumer confidence, falling rents, fewer overseas buyers. Now, Stuart, that all sounds logical to me. If less people are employed, there's fewer people going to be able to purchase properties. Some may even have to sell. What's going on?
It makes sense, doesn't it, that higher unemployment should lead to falling demand for property, both from investors and owner-occupiers. And if demand falls and supply stays the same, then basic economics tells us that prices should fall. So it passes the logic test. But, when you go back and have a look at the relationship between unemployment and property price growth, there actually isn't a relationship and it's all over the place. So what I did is I compared the prevailing unemployment rate between 1980 through to 2017, and then I looked at the subsequent property growth 3 years past that measure of unemployment. And the hypothesis is that if unemployment's really high today, let's assume unemployment's 15%, and to test the hypothesis that it impacts property prices, then for the next 3 years, we should see a fall in property, or at least some sort of negative price movement. What I found is there wasn't any relationship. There were periods, certainly, when unemployment was rising and property prices were falling, but there were only very short periods and it wasn't consistent. But also there were periods where unemployment was falling and prices were falling at the same time, which again demonstrates that there isn't that relationship that logic would suggest. And when we have a look back, and probably the best or most relevant data, if we have a look back at Australia's last recession in the early 90s, what Paul Keating called the recession we had to have, to look at property did back then is kind of interesting, because what happened is property had very, very strong growth through the 80s, some years of plus 20%.
I enjoyed those. They were great days. But then the market slowed down. But I think this is a really good comparison, Stuart, because interestingly, unemployment did much the same then as it's touted to be doing now. It was in the 5.85% as we got into the recession, and it got up to 11.2%. And I think most of us agree that unemployment is going to get to double-digit growth this time. So great example. What happened then?
Very strong growth through the 80s up until the beginning of 89, when property started to fall, and not consistently. I mean, it started to fall in Sydney, and it took a little bit longer to fall in Melbourne. But prices started to correct in later 1990. So sort of that a year preceding a rise in unemployment, property prices actually started to fall, because unemployment didn't start to rise until early 1990, and it peaked at around 92. And really between 90 and 92, property price growth in real terms, if you look at inflation or take away inflation, was steady. It didn't fall. So actually there is very little observable relationship between unemployment and property price growth.
So there goes one of the myths. Why do you think there is such a weak link between the two? Because as we already started to say, it sort of makes logical sense.
Yeah, it does. Well, I think there's practical consequences associated with waking up in the morning and deciding you no longer want to own property. And for most people, that practical consequence is we need somewhere to live. Property is a necessity. Whereas with the stock market or other asset classes, we can wake up and decide, okay, I don't want to be a NAB shareholder, for example, and dump all your NAB stock, and there's no practical lifestyle consequences associated with that decision. Of course, there's going to be an element of the market, such as property investors and people that own lifestyle properties, by the beach and holiday homes and so forth, where they've got more discretion around selling those properties. But then the other factor then that comes into play is the length of time it takes to sell those assets and the cost associated with it. Not only the foregone costs like agent fees and so forth, but obviously then potentially capital gains tax as well. There's a stronger incentive for people to decide not, both emotional and financial, to decide not to actually sell property and really explore every single opportunity to avoid doing so. For unemployment to really have an impact on property prices, there would have to be mass sales. There'd have to be a lot of people deciding to sell their property.
And that's not happening at the moment, Stuart. The banks have given holidays, or you're not getting out of paying your mortgage, but they're allowing you to defer the payments. So what you were saying is correct, that there are those discretionary sales that have happened in previous downturns. You get rid of your holiday home before you get rid of your house. But that also implies that there's actually a longer period of downturn, of recession, of unemployment before you do that. And in the past, unemployment has taken 2 or 3 years to slowly come back to normal figures, whatever normal was at the time. And the Reserve Bank Governor Philip Lowe suggested the same this time round, that even though we are likely to have a short, sharp downturn, recession, and in the last quarter of this year, it's possible, hopeful, that our economy is going to pick up again, unemployment is going to take a while to come down. They said maybe 2023 before we get to their hoped figure of 4.5% or so. But it didn't take as long as for property values to pick up in the past, did it? They picked up quickly and unemployment lingered.
Yeah, very quickly. And I guess it goes to, the areas and types of locations that you're investing in as well. And of course, there's going to be geographical locations around Australia that I think are going to be impacted by higher unemployment, particularly if we think about the sectors in which the coronavirus shutdown has had the greatest impact, like hospitality and so forth. It's going to impact a certain demographic. If that demographic is prominent in that geographical area in which you own property, then yes, you could be impacted heavily. But also then there's demographics that haven't had any impact, haven't been impacted at all by coronavirus in terms of their income. And in fact, because of the lockdown, their expenses, their spending has reduced. So in fact, they'll come out of this probably in a much stronger financial position. The really interesting thing that I've been conversing with clients with is clients have been saying to me, well, this is a bit of a wake-up call, that we didn't have enough cash in the bank, or we didn't feel like we had enough cash in the bank as a financial buffer, or we have been procrastinating investing, and that's really come to light that we really should be taking active steps to make sure that our financial situation is as strong as possible, so that we can weather storms. It's very easy for us to get sucked into the media hype of, it's all negative, it's high unemployment. That high unemployment is going to lead to, reduced demand for property and other goods and services. But we also need to remember, and particularly in investment grade locations, that there is an underlying level of demand by people that aren't impacted, that'll be heavily motivated coming out of this coronavirus situation.
Sure. So, as I've said a few times, we're all in the same storm, but we're not in the same boat. And even if 20% of people are unemployed, and the official figure isn't 20%, but ANZ Bank and Roy Morgan's reports are suggesting that if you take into account underemployed and unemployed, it could be getting close to 20% of our population who aren't getting the income they require. That still means 80% of people are gainfully employed, have got good job security, and people are still buying. Transaction numbers are down. They're down considerably, but there are still home buyers and sellers. And I know we were speaking a short while ago that we're both in your business and ours finding people with secure jobs and good financial position and a long-term outlook. They're seeing this as a window of opportunity, especially those who've been around before and know that this is the time there's a great transfer of wealth.
Yeah, spot on, Michael. I think that's really easy to do for seasoned investors because they've been through it before. They've heard all the stories. They've seen property prices have, short-term negative impacts over a couple of years, and everyone's negative about property, blah, blah, blah. But they've ridden through those waves. Maybe they've held property for a decade or longer, and they've seen the growth. It's been proven to them. And I think it's therefore much, much easier for seasoned existing investors to take that long-term view because they know they've done it before, they'll do it again, and it'll work out fine as long as they get that asset selection criteria correct. But for new investors, it feels very risky, because there's so much uncertainty, so much noise, so many different opinions. But at the end of the day, the best approach, in my view, is to take a long-term view. And you're not trying to guess. I mean, what happens to property over the next year is really not that material. The price that we pay for a particular asset is also less material, which I know we're going to talk about in a second. But what's most material is that you actually get that asset selection right. But most importantly, that you actually make a start and you actually do take active steps to build your wealth.
Well, we all have heard Warren Buffett's famous saying, be greedy when others are fearful and be fearful when others are greedy. But it's really hard to be greedy when others are fearful when you keep getting the negative messages. And we know that the media loves sending us those because we click on those more. It's just human nature to follow those up. So that's, I think, also part of the benefit of having a good team around you, because there's actually very few people who are giving advice today who've actually lived through the global financial crisis of 12, 15, 13 years ago, and then even the recession beforehand. There's lots of new, whether it's buyers agents, property strategists, mortgage brokers, who've only been around for a short time. And what you need to get through this, Stuart, is a level of perspective, don't you?
Yeah, it's spot on. And stick to the fundamentals. The fundamentals almost never change. Well, I never want to say never, but really fundamentals never change. At the end of the day, it's basic laws of supply and demand. And I don't think there's anything in financial planning and property investing and share investing that can't be explained with simple concepts. And that's the best thing to do, is look through all the noise, look for the simple concepts, focus on them, make sure it makes sense, but make sure you keep your eye on the long-term horizon rather than the short. If you focus on the short term, you'll never, ever make any decision. And in fact, if you do make a decision, it's likely to be a wrong one. Whereas if you focus on the question on what can I do today so that in 10 years' time, if we have another pandemic, I'm going to be much better off. I'm going to ride through it, and I'm going to be able to take advantage of all the opportunities that the next situation, whether it's a pandemic or it'll be something, no doubt, that we can't predict today, but it will happen. And we'll see share market volatility, we'll see negative media around property, etc. It'll just repeat that process. So what can you do today so that by that time that ticks around, the next one comes along? And it's typically every 8 to 12 years, somewhere in that range, that you'll be in a much stronger financial position. You won't have to stress. And in fact, you can, as you say, be greedy when other people are being fearful.
Well, I think two things come from what I just heard you say. People are asking me, Michael, how's your strategy changed for the current circumstances? The answer is it hasn't, because I'm got a long-term perspective, and I know we have very similar philosophies about buying in capital cities, buying investment-grade properties, choosing the right location, choosing the right property in the location. But I think the other thing that you have done for our clients and your own clients as well is set them up with the right financial structure. So the right finance isn't getting the lowest interest rate. It's actually having those financial buffers to see you through. And those clients who have been set up correctly, and up till now, I thought, why didn't you push us? Why did you actually leave some money on the table? Why did you leave some in offset accounts, in buffers and redraw accounts? This is the reason why, because we don't only buy properties for clients, we help our clients buy time to ride these unknowns. Because as you say, they'll come again. We don't know what it's going to be, but it will be back, won't it?
Absolutely. And finance and access to finance, I think, is the absolutely fundamental aspect you need to get right. It's like the air in the tires. If you don't have any air in your tires in the car, you're not going anywhere and you're not going to achieve anything. And the same with access to finance. Now, if you could magically wave your wand and go bang, you have unlimited access to finance, you could build, as long as you make really smart, prudent decisions, you could build ridiculous amounts of wealth. But the reality is that's never going to happen. Everyone, no matter even if you're a billionaire or you've got $5 to your name, everyone has a limited amount that they can borrow, whether that is dictated by either the lenders or what is actually the most prudent thing to do, because it's not prudent to go and borrow $10 million if your income's only $100,000. So everyone has a maximum borrowing capacity. And then therefore it's about allocating that scarce resource. And so sometimes people think the scarce resource is the investment assets, the property. But they are scarce in context of the overall supply of property, definitely, but they're not scarce at an investor level. If I had an unlimited amount of funds, or if I was Michael Yardney, who does have probably an unlimited amount of funds, I could go and buy, 10 properties a year for the rest of my life, and that would be magical. But the reality is I don't. So therefore, it's about allocation of scarce resource and also maximization of scarce resource. And that just means making sure whatever borrowings you have are working as hard as possible for you. So that is, they're invested in the right assets. And then also taking proactive steps to maximize that scarce resource, which is borrowing capacity. If you do those two things well, it goes a long way. It's the air in the tires. It goes a long way to fulfilling the journey. But if you don't do those two things well, doesn't matter. It really doesn't matter how well you do on the investment side. You're probably just not going to get anywhere.
Which means that timing is nowhere near as important as some people think. And we'll get onto that in a moment. But before we do, I guess one of the things I'm seeing moving forward, Stuart, is that there are fewer transactions at the moment. And those who are sellers, most of them are non-discretionary sellers. In other words, you wouldn't put your house on the market today to sell if you didn't really have to. And it doesn't necessarily mean mortgagee defaults or financial problems. There are other personal circumstances, including having just bought a house. So it's likely that some of the buyers currently in the market are going to take advantage of the opportunity, and sellers are going to sell at a price maybe they wouldn't have liked to have had to sell for. They would have got more 4 months ago and probably will get more in a year's time. So in the short term, I can see some property value figures coming out that are going to show prices are dropping a bit. Interestingly, that hasn't happened just yet. Transaction volumes have gone down a lot, but prices seem to be holding. But I think when we do get this data in the next month or two, it's not really going to be representative of intrinsic value. It's really not a good indication of what's going on for properties in general, just like at the moment, those silly auction clearance results when there's hardly any auctions and most of the properties are withdrawn because, not because they can't sell, but because they're not having auctions. So I think taking into account data at the moment, it's actually difficult interpreting what's coming out, Stuart.
Yeah, and it has very limited application for investors. It makes for good reading. So newspapers like it. If you're doing macroeconomic studies over a long period of time, and you want to get build a sort of trend around property prices and housing affordability and those sorts of things, yeah, median data is probably relatively useful. But to investors like you and I, it's relatively meaningless. It gives us a sort of general sense of what's happening in the market, but it doesn't. It's not a signal of whether we should buy or sell assets. Remember, it's just the midpoint of all the sales. So, as you say, if all those sales are dominated by either vendors that are very motivated that have to sell for a financial reason, or vendors that where price is not the most important factor, and we all like to think that we're all logical human beings, so how could price not be the most important factor when selling a property? But you come across plenty of transactions where people just want to sell and want it to go to a person that's going to love the property as they have loved it. And in
Yes,
fact,
that's
whether
true.
they get $100,000 extra or not, it's not that important to them. Normally, they're a minority in the market naturally, but at the moment, they might still be a majority because they're those other vendors, the discretionary ones, as you say, Michael, where price is the most important factor, and they're happy to wait to get it, just won't go and sell in this market. So, yeah, it's funny how the media will say, "Look, properties dropped 10%," and they extrapolate that data to suggest that every property has dropped 10% in value. I mean, it's just a nonsense, and we just have to understand, what is the data, how important is it, and how should I use it or ignore it when making my own financial decisions. And the other thing I will say, I have almost always over the last 20 years ignored suburb median data. If I look at median data, I'll look at it at a capital city level because you've got a statistically better representative sample of what's going on rather than suburb data, particularly if the suburb is a small geographical location. There just won't necessarily be enough sales in that month or quarter to provide you any sort of meaningful data. Because I always enjoy those articles where they go, "Oh, Brighton's up 20% or something like that." I mean, wouldn't that I mean, it could be in some markets, of course, you get some pretty significant price rises, but whether you can draw that conclusion, it's very questionable.
They're usually small suburbs with very few transactions that, as you say, are not statistically meaningful. I think one of the things in the minds of people interested in taking advantage of the property markets at the moment, whether they're home buyers or investors, is how do I get the timing right? And when I speak to them, it's actually not really the timing they're wanting to get right, Stuart. It's what they don't want to buy now and find that in 3 months' time they could have got it 10% cheaper. What would your answer be to people about timing?
Yeah, that's just mostly ego, I think. Not I think, I'm virtually certain. I mean, I did an analysis about 18 months ago, and we can put a link in the show notes if you like. But
I'm going to put a couple of links in the show notes. First of all, to your great blog about the link between unemployment and property price growth, the discussion we had a couple of minutes ago. And yes, I do want to talk about this study that you did, and there will be a link in the show notes to that too, because it was in the context of the federal election when there was uncertainty as well. Totally different reasons for uncertainty, but people were unsure. Are the tax laws going to change? Is finance going to change? So I was very impressed with your detailed study of looking at the many factors that affect property returns, cash flow and capital growth. And then you singled each one out and you actually saw how it would affect over a holding period of 20 years, owning an investment property and selling at the end, which I know you don't necessarily recommend. But at that time, there was a question, what would happen if capital gains tax came in or out? So in summary, what were the major factors that you found in giving investment return when you did that very detailed study?
there was only two that stood out, and the rest, I think I compared sort of 8 or 9 different factors, and the rest were virtually immaterial. and or you couldn't control them anyway. So the two were the one by far was the capital growth rate, and that's just around the power of compounding capital returns. That's nothing magical. That can be explained with simple maths. There's no smoke and mirrors there. That if you can invest in an asset that provides most of its return in capital growth rather than income, because income's taxed each year and capital growth isn't taxed until you sell the property, that reinvestment, that compounding capital growth is a magical thing and ultimately helps you build your wealth. So that was number one. And then number two was the amount of capital gains tax that you paid, which is only relevant if you're going to sell the property. I mean, you can't take it with you, so you're probably going to do something with it at some point in time, but it forces us to start thinking about ownership structure and the future and diversification of ownership structures and so forth. But most importantly, timing. So that is what I compared is if you bought a property less than intrinsic value compared to paying more than intrinsic value. So that's the situation, Michael, that you talked about, overpaying for a property. Virtually had no impact on the longer term returns. And that's kind of surprising. We like to think possibly that, buying well or getting the timing perfect. I mean, it's nice to do if you can do it. It's ridiculous to suggest that you can build a strategy that's going to be where you're going to be able to execute on that idea that you can time it right. I mean, you just can't. No one knows what's going to happen next. The smartest investment minds in the world, that's all they've been saying over the last couple of months. No one knows what's going to happen next.
So you just busted another myth. First of all, the myth regarding unemployment and property values, and now the timing myth, because a lot of people say you make your money when you buy a property, but it's not because of the timing of it. And Stuart, it's not even because you buy cheaply. Your study showed that it was by buying well means buying the right property that's going to grow at wealth-producing rates of return rather than average rates of return because of that compounding effect and the ongoing compounding effect.
Yeah, and that's why I like evidence-based investing, Michael, because evidence-based investing suggests that you should only adopt a methodology or course of action where there's overwhelming evidence that demonstrates that if you do that, you'll be successful. It's not throwing darts at a dartboard. And like I said at the beginning, there's nothing so complex in investing or financial planning that can't be explained through simple concepts. And this analysis is really just simple maths. I mean, you can explain it if you just understand the maths. You don't need to, it's not a property specific analysis. And I like it because it demonstrates, you don't need to listen to X person about their view on property. And everyone has a different view, I guess, and a different methodology. This is really about this is what works. And so then you can identify what is the really one factor that you need to focus on to absolutely nail. You and I know that you could mess everything else up. The finance to some extent, the tax planning, if all you did in the 80s is just buy good quality assets, you'd be sitting on a gold mine. And so really it does come down to asset selection in terms of generating that after-tax return.
Great. Well, that's another myth thrown away. Now, let's talk about a couple of other things that I got out of some of your recent writings. One of the things you mentioned was let's expect a lot of noise about property and the property market is going to get louder. I think we've already mentioned the idea that most of that noise is going to be negative. So it's going to be difficult at times of uncertainty like this to make financial decisions. Uncertainty can come in a number of different ways, Stuart.
Yeah, it can. So, and it's crippling. For most people, it's crippling, and they tend to avoid making a decision, which is almost, I was going to say almost as bad as making the wrong decision. Not quite, but sometimes it could be. There's really three types of uncertainty as I see it. There's personal uncertainty, domestic and international uncertainty. Those three different causes or categories of uncertainty should require then three different responses. So personal uncertainty is really around something specific to you, whether it's a deterioration of a relationship, you losing your job, your income reducing, your expenses going up. These are the sorts of things that might be on the horizon that you worry about, that is specific to your personal circumstances. And the best way to deal with that level of uncertainty is actually to do nothing. Because what I find in my experience is that if you just wait a little bit of time, you either sit with the idea and mull over it and let it marinate for a while, or you wait for the events to either transpire or not. That uncertainty eventually disappears. Now, you can't wait forever. So after 12 months, you're in no further certain circumstances, well, then maybe you've got to proceed in some sort of way that sort of accommodates that risk as best as possible. But I find that's not often the case. I find that if you wait a few months, typically these things will clarify. And I was talking to a client yesterday about she was potentially wanting to upgrade her home and move to Hawthorn in Melbourne, which is a lovely suburb that has more of a village atmosphere, and that's what she was after. And there were some consequences associated with that. Anyway, she's going to mill over it for a while. And my gut instinct is that after a couple of months, you'll either have a very strong desire to do that, or the idea will just dissipate. And so that's sort of the personal uncertainty element. Then there's domestic uncertainty, and probably the best example, which is really uncertainty that relates to Australia. And typically it can be a tax rule, a change in economics, these sorts of things. And probably the best example was last year through the federal election. The Labor Party was contemplating getting rid of negative gearing, increasing capital gains tax. That's specific to Australia. The best way that you can deal with domestic uncertainty is through your investment strategy. So no investment strategy should be so single point sensitive that if the government changes one particular rule, that your whole investment strategy is shot and you've got to throw it all out, sell all the assets and start again. That would just suggest that you don't have a very good investment strategy. Now, of course, some of these changes that were being contemplated, they might be material, but they wouldn't make or break a good quality investment strategy that's well diversified. And the last one, which is global uncertainty, which I guess you could put coronavirus in the category of, although it might occupy all three categories at this stage. There's not much you can do around global uncertainty. And really, it just comes down to a little bit of asset allocation and then understanding that everything moves in cycles and you just have to invest through those periods and put faith in your methodology and your asset selection principles that in time they will weather the storm and they'll still provide good returns. So I think it gives a context for people to deal with decisions. They can ask themselves, which category does it fall into, and is it a case of waiting? Is it a case of accommodating through my investment strategy, or is it just a case of this is how it goes and everything moves in cycles?
I want to pick your brain on the finance side because I know your background is as an accountant and you've got financial planning background as well, but your team also gets involved in finance. Currently, people are wondering, should I refinance? Shouldn't I? Interest rates are lower. How are valuers looking at properties at the moment, and how are banks looking at refinancing considering interest rates are so low?
Well, I've always tried to say to people the best time to borrow is when you don't need it, which means that the best time to borrow is when you have no plans for the additional borrowings. And the reason for that is that it gives you plenty of airtime, plenty of space to make prudent decisions. You're not under any time pressure and you can be strategic about it. And when I say strategic, one of the things, as I talked about, is maximizing your borrowable equity. And a big component of that is bank valuations. Now, it doesn't always make sense if you've got a number of properties in your portfolio. It doesn't always make sense to revalue them all at the same time. But what you often see is people tend to wait until there's a transactional need. And then that transactional need dictates when you revalue properties. And it doesn't make sense. Properties in different areas, they're very heavily reliant upon comparable sales sales that are in very close proximity, that are very similar to your property, that have occurred within a 6-month period. Now, unless it's a very, very buoyant market where there's massive transactions going on in every sort of geographical location, it doesn't stand to reason that it's always good to revalue properties at the same time. So I think, or I know that what people should be doing is revisiting their loan portfolio and just asking themselves the question, should I revalue this property? Is it worthwhile doing that? And not be guided or dictated by the transactional need, or even a need dictated by the bank. If they start increasing interest rates or something like that, that seems to me to be very reactive. I can give you a bit of an example, a personal example, is that I just recently refinanced from Westpac to ANZ. Some of my loans switched across. So I started that process about 8 months ago, which is just ridiculous, but gives you an indication of how. We've got a bit of a complex structure, sure, but it shouldn't take anywhere near 8 months. But it does give you a good insight to how difficult refinancing can be at this stage. I approached Westpac to restructure those loans in the first instance. They didn't oblige. I ended up refinancing to ANZ, pulling out heaps more equity than what I would have or could have done with Westpac. I saved a bit on interest rate, but it wasn't really about the interest rate. I couldn't care less, really, whether I'm saving 20 points on an interest rate. I'm more interested about the equity. And as it landed, we completed the refinance in March, I think, March 2020. So it was kind of perfect timing. I'm now in a situation. I never predicted, obviously, that this situation would occur. But now I'm in a really good position where I've restructured my debt. My repayments are significantly lower than what they were at Westpac, so that makes my financial position stronger. I've got access to a whole bunch of equity, and I can put that equity to work if I wish. That wouldn't have occurred, obviously, until I waited. If I waited for the coronavirus to occur and then think, oh my God, it's going to be a good buying opportunity this year, I'd be too late to some extent, or at least I wouldn't be in the same position, but knowing that refinance takes a little bit longer. So probably the best advice, and it doesn't necessarily only just apply to this period, but the best advice I can have to people is to be really proactive. And then my only other observation, Michael, is that if we know that comparable sales will have a big impact on our borrowable equity, that we've then got to realize that as we spoke about previously, if the market is dominated by people that have to sell, or that price isn't their dominant concern, then comparable sales in 6 months' time aren't going to help us very much, or might not help us very much. And therefore, if we're contemplating a refinance in 2020, it's probably better to start that process sooner rather than later. And the good thing is a mortgage broker can order a valuation straight away. So there's no delay in terms of getting your paperwork together and so forth. A mortgage broker or a bank, you can walk in and they can order a valuation tomorrow. So it's something that you can consider to lock in some equity, even if you have no plans to use it.
I think that's great advice. And what we're finding is that there's a group of people who are taking this window of opportunity, this coronavirus cocoon when everyone else is hunkered down, to actually set themselves up for the next stage. So even if they're not ready to buy right now, it is taking a lot longer, like you just mentioned, to get yourself set. So they're speaking to their consultants, seeing what available equity they've got, seeing what finance they can get, putting a strategy together, getting their ownership structures right, because there are going to be some great opportunities. And it's going to come, I think, sooner rather than later. At the time of recording, we're starting to see a light at the end of the tunnel. Now, Stuart, I know we both believe in the concept that residential real estate is a game of finance with some houses thrown in the middle, and you've written a number of books, and your most recent one, Rules of the Lending Game, is just about finance. What made you write a book on finance, which some people would consider a boring topic?
I'm not promising it's not going to be boring, Michael, but it is hopefully very useful. I started Pro Solution back in 2002, and really at that time, you could walk into a bank and just go, $1 million, please, and no problem. Here it is. There would be almost virtually no questions asked. And I remember back then when we were helping clients borrow, things were just so lax and too lax, admittedly, and it was misused by some rogues in the market. But it was very, very lax. You go and borrow some money and maybe after the fact they'll ask for an application and a payslip. Whereas today, it's a forensic.
They were good times, Stuart.
Good times, yeah. Yes, yeah. Well, it's interesting, that's for sure. And it's certainly less fun today to go through the almost forensic investigation that a lender will take you through. So that's why I wrote the book, because it's just like playing the game of Monopoly, I think. And what you need to do is first learn the rules. And as a kid, you do that when playing with your family. And then as you mature and you start to apply a bit of thought to it, your strategy then is to work out, how do I best play those rules to my advantage? And I've enjoyed seeing that unfold when playing Monopoly with my two sons, and seeing them sort of strategize to work it out. But it's no different with lending. If what you want to do is maximize your borrowing capacity, you have to learn the rules, and then you've got to learn how to use them to your advantage. And that's what the rules of the lending game does. It helps people understand what's changed, because a lot has changed, and then how can you best navigate those changes? Because ultimately what we're still trying to do is borrow the most we can in the safest possible way, and not over borrow. I'm not suggesting that people should just go and borrow to their eyeballs, not at all. You need to think about serviceability and how you're going to one day repay the debt and those sorts of things. So you've got to be prudent. But these days, unlike the past, I've got clients where I think they can safely borrow X amount, but it's difficult to find a lender that's going to lend that amount. Whereas in the past, as you would know, Michael, that the amount that the banks would lend was almost always a lot more than what someone should prudently borrow. And it's just not the case today. So you just have to be really proactive. And the best way to do that is to, as I said, I keep saying, understand those rules of the game, but really play lenders off. I don't really care whether my loans are ANZ, Westpac. I don't really care about the interest rate too much. I don't want to get ripped off, but I just want to pay a market rate, because I know the most important thing to me is maximizing my borrowable equity, and that'll make me a whole lot more money than saving 15 points on an interest rate.
So what you're saying is that there are rules of the game, and the average person doesn't know them. That's the problem. I think they think if they go into a bank, the bank's going to help me. The bank people are in general not on your side. They're not going to tell you that they can only offer you a limited number of options. They're not going to tell you that a different bank may actually have different options for somebody in your industry. They're not going to tell you that they're actually salespeople who are incentivized to sell other solutions, including credit cards and insurance. I know, Stuart, they're not going to tell you that there's 3 doors from the bank: the front door, the retail door where the mums and dads go in, the business branch for larger accounts, and the institutional branches that the big boys go to. So I know you have access, as do most or all finance strategists, basically, people in the bank who you can ring up and say, hey, I've actually got this particular client with these challenges. I know the banks aren't going to tell you that mortgage rates are negotiable, or that an offset account would be better than putting money in a term deposit. There's all these things that fees can't be waived, that the system actually chooses the finance applications. They don't tell you to shop around. So you actually need somebody on your side to level the playing field, don't you?
Yeah, and the other thing too, Michael, is that the thing that creates a lot of frustration and often mistakes from the borrower's perspective is they try and apply logic to some of these decisions. Sometimes there is just no logic. That is just the way it is. Like if you have a look at my example with Westpac, how that came about was about 3 years ago, I randomly purchased a property. I say randomly, it was on the market and it had been on the market for a while, and the vendor, they were going through a marital separation, and the vendor just decided, that's it, we're selling it today. And I had to make a decision within like an hour about what I could offer, and it went to the highest bidder. So anyway, I was lucky enough to be in the right time in the right place and buy that asset, as it happens, really well. But then it put me in a bit of a position because I didn't have my finance lined up, and I had to negotiate with Westpac. In any case, Westpac were happy to provide the finance, but the credit manager at that time made a decision. This is what we'd like some extra repayments, et cetera, et cetera. Now, when I went back last year to renegotiate that facility, even though my equity position had changed significantly, my financial position had changed significantly, obviously for the better, what it required was a credit manager to override or overrule that decision that was made 3 years ago. Now, if you understand what's going on in the banks, and what's going on is that much tighter compliance, and people don't want to put their certainly their bonuses or any variable income on the line, which has been the case if there's any sort of slip-ups, and even most importantly, their job on the line. So if I'm a credit manager in the bank and I'm saying, look, Stuart Wemyss wants to change his structure. We set this structure up 3 years ago. Essentially what I need to do is overrule this credit manager. No way am I going to do that. Why would I do that? The answer is no. I can argue till I'm blue in the face about, oh, look, the LVR's dropped to 60%. Or my income has risen and interest rates have gone, so serviceability is a no-brainer. It doesn't matter. I'm not going to put my job on the line. So sometimes there's no logical reason. I could be still arguing blue in my face until I'm blue in the face at Westpac today, and I would have got nowhere closer to getting the deal done. So you've got to understand the system. You've got to be able to then play the system to your advantage. And sometimes you can argue and win, and sometimes you can't. Sometimes switching lenders is the only option, but making sure you choose that right lender to switch to, because ANZ, for example, for me, is not going to be the best bank for the next 10 or 20 years. Without a doubt, I'm going to have to switch. And that's just the way it is, to know those rules and then how to play them to your advantage.
Well, that means we're going to have to get back together again soon and go through the rules of the lending game. The name of your new book, Stuart Wemyss, which I'm actually going to put a link to in the show notes. And I'm going to recommend that people listen to your podcast, because I do. I enjoy it. And read your blogs, which on Property Update every now and then, and regularly on yours. So I'll put some links in the show notes to that. Thank you very much. You've busted a couple of myths, and you've also given us a couple of interesting things to think about. Some fun times ahead for those who know the rules of the game. Thank you for your time, Stuart.
It's been a pleasure talking to you again, Michael. Thank you.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to talk to those people who don't understand why some people want to become wealthy. They actually knock them. It's that tall poppy syndrome, and they say it's an unworthy attainment. To become wealthy, to become rich, it's not right, it's not fair. I see this in people on the internet who hide behind pseudonyms, who troll people, who speak good things about developing a property portfolio, developing financial independence. The problem is most people who attack wealth have never actually learned what it takes to create wealth. Instead of learning how to make sacrifices to create wealth, they prefer to throw stones at those who've already become wealthy or are trying to or aspiring to. I believe you've only got the right to say financial wealth is not worth it after you've created it. Otherwise, you're simply just justifying your lack of willingness to make sacrifices by attaching honour to not wanting to become wealthy. If you're so honourable, why don't you make a lot of money and give it away? That would be the true test of your benevolence, wouldn't it? Don't forget, charities get most of their money from those people who already got money, not from those who deny its importance. Those at base camp shouldn't say it's not worth climbing the top of the mountain. Only those who've reached the top of the mountain have got the right to say that. And you know what? You're really going to hear them say that. By the way, I've been on both sides, so I know what it's like, and I feel qualified to talk about this. I came from migrant parents. I was born into a house where there wasn't much money, and we had to make sacrifices. So now, stop making excuses and start making sacrifices. You know you want a better life financially, so stop spreading self-deluding lies and start making sacrifices, those sacrifices that those who already have developed wealth have already made. Now, this may not be related to you, but maybe somebody you know, maybe it's worth telling them this message. Well, at the beginning of today's show, I told you that my chat with Stuart would possibly question some of your assumptions about what's moving forward. Hopefully, you've got a little bit more clarity now. And now, hopefully, you're going to understand that it's, for many people, going to be a good time to either take action or at least just set yourself up for the opportunities that are going to present themselves as the market moves on, which it surely will. And why not have the team at Metropole on your side to help you with direction, with guidance, and get you results, wealth-producing rates of return. In challenging times like we're currently experiencing, you need an advisor who has a holistic approach to your wealth creation. That's exactly what you get from my multi-award-winning team at Metropole. Go to metropole.com.au and find out about what we do. You'll understand that we give strategic property advice. We can build a customised strategy plan for you. We have Australia's most trusted buyer's agents. We have wealth advisory with Ken Race, property management, property renovations or property development. Go to metropole.com.au because I'd love to be part of your wealth creation journey. And if you got some benefit from today's show, why not tell others about it? Because together we can help more Australians become financially fluent and work through this challenging maze we're walking through together. If you'd like to tell the world, why not leave a review? 1 star, 5 star, I don't mind, on your podcast app that you're listening to. I'll be back twice a week, but in between, you can catch me on social media. Just look for Michael Yardney or in my daily property update newsletter. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?